Good morning, everyone. We're going to go ahead and get started. My name is Sophia Nyborg Anderson, and I'm excited to welcome you to our webinar today, Financial Projections. As everyone's getting online, I'd like to start out by sharing a little bit about the SBDC for those who are not familiar with the program. Essentially, the SBDC at the University of La Verne is a grant-funded program through the Small Business Administration and the Governor's Office of Business and Economic Development to help businesses get started and grow. And we do this two ways. We offer free workshops and webinars just like this one. And then we supplement those workshops and webinars with free one-on-one business consulting to help you be successful. If you're interested in signing up for free consulting, we'll put the link in the chat to sign up, or you can always give us a call at our office. Also, as we get started, I'd like to take care of a few housekeeping items. Everyone will be placed on mute to help eliminate any background noise. But please submit your questions using the Q&A feature on Zoom or the comments section if you're watching this on Facebook, YouTube, or LinkedIn. And don't be shy. We want to make sure your questions get answered. Josh and I will be co-hosts for today, and we will be helping moderate the questions, and we will address all the questions at the end, and we should have plenty of time. The slides will be made available after the webinar, and this webinar will also be recorded as well. So if you need to drop off, we've got you covered. And all right, with those housekeeping items out of the way, I'm pleased to announce our speaker for today, Sean Snyder. Sean grew up in a family business and he has a bachelor's and master's in entrepreneurship. Sean has a wealth of knowledge when it comes to creating business plans for new and existing businesses. Sean is a consultant and our director here at the University of La Verne SBDC. And without further ado, please welcome Sean Snyder.
Thank you so much, Sophia and Josh, for putting on today's webinar on financial projections. It's an oldie but a goodie. Definitely applies to business owners at, well, just about any stage of development. And as we get started, I want to give a big shout out to our chamber partners who are helping us cross-post this event on Facebook. So be sure to give us a like, comment, or share to get this information out to, well, those who need it. And those who need it might be just getting started and going, Sean, is this business financially feasible? All the way down the line to, I've been in business for many years, Sean, and well, now my bank is asking me for a loan. I'm asking my bank for a loan rather, and they're asking me for financial projections. My plan is simple. It's to make money. Where do I start? So what we've got on tap for you today is a fun-filled agenda, a tool we're going to go over to help you in that process of developing financial projections. We're going to demo it live so you kind of know how to use it yourself. And then thirdly, if you need help along the way, that's where the SBDC comes into play here at the University of La Verne. We use this a lot with our clients. So without further ado, let's go ahead and get into it, shall we? And the first thing I'm going to share with you is a spreadsheet. I know everybody's thinking, ugh, but it's a really cool tool. I've seen a lot of financial spreadsheets over my tenure here at the SBDC, and I tend to be partial to the SCORE financial projections template, the way they've got it broken out. So we want to make sure you get a copy of this spreadsheet first and foremost. And I know there's probably some people on the line that use, numbers for Mac or Excel for Windows. So what I like about this template, we've basically taken their Excel template and dropped it into Google Sheets because Google Sheets is internet-based. So it doesn't matter what kind of operating system you're working from. But we will drop in the chat the links to both the Google Sheet and the Excel version. Both are the same. But we'll be walking through this and, helping you think through your business from a financial perspective and really help answer some of those, head scratcher questions like, hey, Sean, how much can I pay myself? How much can I afford to spend on marketing? Can I afford to pay back this loan that I'm asking for? And that's probably why the bank's asking you for some projections to kind of think through this a little bit more. But I like to get right into it. But that's kind of what we have on the agenda for today. This is the spreadsheet, and we are going to put some links in the chat. I believe Sophia already has. Perfect. for both versions. So the Google one, I will say, the Google Sheets, you do need a Google account or a Gmail account to access it and to add it to your drive. It's going to force you to kind of make a copy. That way we don't have to help you navigate through that process. Just one click, make a copy, and it's going to open. The Excel version, you will need Excel to follow along or to kind of look through it. But when we're starting a business or when we're doing financial projections, I will speak to both startup as well as established businesses because it's a little different, or there are some nuances. But first and foremost, when we're doing financial projections, we have to have a starting point or like a jumping off point. And so that's this first tab here. And as we go through this spreadsheet, we have a number of tabs down here at the bottom that we're going to be helping you navigate. But just know that basically once you get through tab 5A, you're pretty much done. So it's basically 5 tabs that we're going to plug in some assumptions. Really, that's all financial projections are based on. It's assumptions that relate to some financial activities. But once we get through 1 through 5, essentially, you will have a cash flow statement, an income statement, and a balance sheet for 3 years, which is wonderful. And that's usually what people are being asked for by their bank in terms of their pro forma. But we will also take a look at probably the best thing about doing a financial projection is your break even. At what point of sales do you cover your costs and then begin to maybe add to it? What is that unit volume? We're going to take a look at that as well. So as we kind of look and start out at the starting point tab, we have, kind of 2 boxes here. First and foremost, we've got some fixed assets and some operating capital. When I'm usually talking to an established business, I will usually ask them for a balance sheet for the last fiscal year end date. Because on that balance sheet, you're going to have things like, land, buildings, leaseholder improvements, equipment, furniture, etc., that we can kind of drop those figures right in. So if you're an established business and you're starting on this starting point, get a copy of your balance sheet as of when your jumping off point begins. Usually, in this case, we're going to say we're doing a business plan for 2024. We're going to start in January of 2024. But for my startup businesses that are kind of pushing some numbers around, trying to say, hey, is this going to work? Well, this template gives us a place to start to think about the costs that we may need to incur just to get started. And, we're going to go through them line by line. So like land or buildings, maybe, I'm going to use the example of a Taekwondo studio. So we might not need to buy land or buildings, but we may need some leaseholder improvements. And so through the magic of Hollywood, I'm going to go ahead and kind of expedite things a little bit here. And I'm going to drop in some common startup expenses that I might expect to see for a Taekwondo studio. So we can kind of go through them. Now, I also at this time want to point out for my startups that we have this handy dandy common startups expenses that you might want to take a look at because you kind of don't know what you don't know until you know. And I've learned a lot from businesses over the years and helping them do their budgets. And I put together this PDF basically to help kind of add these numbers up and think about the different types of expenses that they might incur. And so as I'm, kind of at the starting point for, what do you call it? Let me open this up. A Taekwondo studio, we might not need to buy any land or buildings. That's great. But we may need to fix up the space that we're going to move into. And here we're calling them tenant improvements, but sometimes that's called leaseholder improvements. And essentially we're fixing up someone else's space. So enters the conversation of who's going to pay for this, me or the landlord? And that whole negotiation process that you might want to talk about with your SBDC consultant. But a lot of times, your landlord will give you a tenant improvement allowance of a certain amount. If you go over that, it's on you. And so this bucket right out of the gates of tenant improvements tends to incorporate a lot of things. So when I started the SBDC here at the University of Laverne, we had to do some carpet, we had to paint, we had to drop some electrical lines. So here we've got some things to consider and little placeholder text where for electrical alterations or additions, sure, let's say $2,500. And then for plumbing, we had a sink in one of our offices that I had to drywall over. So yeah, let's say $1,000 for that. But you can see how, as you plug in the numbers here, they start to add up into this total bucket of tenant improvements. But there are a lot of other things to consider. And so we put this PDF together to kind of help get the gerbil running, or the thought process going when it comes to these various kind of categories. Because yeah, they make sense, furniture and fixtures, but here it's okay, how many tables at what price per table, or chairs? Because I had to kind of furnish the office with a couple of desks, two task chairs for every, so it starts to add up. And we wanted you to have this as a resource as you're going through the budgeting process, especially for our startup businesses, where you're just kind of putting together what I call your ingredients list to start this business. If you're making a new dish, you're going to have to go get some ingredients to make it. When we're making a new business, so what are those ingredients that we're going to need? And so beyond just leaseholder improvements, I'm going to say $30,000 for our dojo. For some, I'm thinking about my son's Taekwondo studio when he was doing it. There's a nice wall mirror that was the entire wall that had to cost something. The floor had that mat built into it. Obviously, you might need to paint and other things, but really hone in on that and break it down so that you can know what you're going into. And every space is going to require a little bit different, probably TI, as they also call it. But other equipment, I'm saying, yeah, let's say $10,000 for some POS equipment, maybe some laptops or some computers. We're a dojo, so punching bags and, cool stuff like that. Furniture and fixtures, yeah, we're going to need some tables, some chairs, some office furniture for the desk. But the tables and chairs for the, the parents who are bringing their children to learn Taekwondo, where they can sit while their students are practicing or studying. And right away, with those three things, we're already at roughly $45,000 of just to get started before we've even sold our first membership, if you will. But there will be some other expenses as we look at this kind of initial jumping off point. The difference, though, between these fixed assets or long-term assets is we're going to depreciate these over a useful life. So hopefully those tenant improvements last us, let's say 7 years, or this, this computer also, or the furniture before we have to go buy some new stuff. So this is where the spreadsheet will take care of a lot of things like depreciation and amortization. So some business terms that are a little scary. Don't worry about it. It's got you covered. So, but these expenses down here, what more or less I would call are consumable, things that we're going to, use in the first year. So here we've got a lot of categories, but I'm going to say prepaid insurance premiums. Yeah, we're going to have to sign a lease. And in that lease says, we're going to have to carry a general liability insurance policy of X or Y. And so I'm budgeting $1,000. Legal and accounting fees, sure, why not? I'm budgeting $1,000 for an LLC formation and someone to review my lease, because, well, when you add it up, your monthly rent times 12 months a year times however many years, that number gets up there pretty quick. And actually, that's the next one here is rent deposits. To sign a lease, usually a landlord's going to want a little collateral, a little something. So first and last month's rent, I'm saying $2,500 a month. The landlords, just to sign the lease, they're going to want to see $5,000 check in terms of a rent deposit. Now that's money that they hold for you. That's technically yours. So it is still an asset on the books, but it's money you're going to have to come up with just to move in. We all remember when it was when we were 18 years old and got our first apartment. Well, you call the electrical company and you don't have any credit yet. You're just, brand new starting out. And so they go, well, we're going to charge you usually about 1-2 months rent or usual utility bills. So that's kind of where we're at when we're starting a business. And so I've thrown in utility deposits of another $500 for, let's say, gas, electric, water, etc. We're going to need some supplies like paper, ink, toner, uniforms and belts. We're going to be giving, free 2-week trials. And with your 2-week trial, when you sign up, you get your nice, new uniform and your white belt to start with. So that's going to cost us something. Let's see, advertising and promotion. Yeah, I'm throwing in $3,000 here, kind of assuming, maybe $2,000 for a website, basic website so that people can learn about us online. and a grand opening with our awesome Chamber of Commerce. If you don't know your Chamber of Commerce, get to know them. They're a really great resource in the community, not just for grand openings, but for a variety of other things like resources in terms of a lot of the other professional service providers you're going to need to know to manage your business. But aside from that, I'm throwing in $250 for licenses for the city business license, but I will jump over to our common startup expenses and go on down to our licenses category, because this one, it can be a big one. City business license or home occupation permit, maybe if you're doing a home-based business, but a burglar alarm permit, zoning, police, fire inspection. Hopefully you don't need a conditional use permit, sign permits. I mean, like, the list of permits can go on and on depending on the type of business that you have. So again, just like tenant improvements, sometimes this one adds up, sometimes it doesn't. But and then the last but not least is working capital or cash on hand, because this really isn't necessarily an expense to start your business per se, but it's money that we need to earmark or have in the bank to just get started, to start the ball rolling. And so a lot of people kind of omit this or don't think about it when they go to start their business. And then inevitably, you're meeting with your banker to set up a new bank account. And they say, okay, Mr. Schneider, how much are we putting in today? And you go, oh yeah, that's right. I need some money to kind of start with. But that's going to be probably the most important number, whether you're just getting started or you're an established business, for this whole projection process, because we need a certain amount of money in the bank to start with. Now, we could start with zero theoretically, but usually that's not the case. You need some working capital or cash on hand, they call it, to kind of get going or continue into operations. So we're looking at $32,000 in working capital or operating capital, but when we add it to our long-term or fixed assets, we're saying here it's going to cost us $76,500 to start this dojo. Purely fictitious numbers, mind you, but that's a chunk of change. And so now begs the next question: where's that money coming from? Right? Show me the money, Sean. Show it to me. So I'm going to say, I'm coming in with $50,000 of my hard-earned cash, and that's this category called owner's equity. And let's say, I'm putting, for the sake of example, I'm going to get a micro loan of $26,500 because you can see here it says you require more funding. You're not balanced. And essentially, what we're doing here is we're creating a beginning balance sheet, which if I tab out, I'm going to say $26,500 at 10%. Over 5 years or 60 months, which gives me my monthly payment of $563. So when I said we're creating a beginning balance sheet, all a balance sheet really is assets minus liabilities equals owner's equity. So here are all our assets. Here's our liability and then here's our equity. This is our skin in the game. And usually a micro lender is going to want at least 25% the total project cost, which is the 76,500 figure, to be coming from you. Yeah, you guessed it. They don't want to finance the whole thing. So just keep that in mind. But right now we have done the starting point, and I went through it really quick because I want to make the best use of our time together. But this is really where it does take some time. And sometimes it's a straightforward business, let's say like a consulting business, where we need some cash in the bank. We already have a laptop, we have some of these assets, but it could be more involved, like our Taekwondo studio or a restaurant, where you do have a lot more of these bigger ticket items to consider. But we want to think about how much it's going to cost us just to get started and get going. And that's what we've done here. And a lot of times the bank, if we were going to a lender, they're going to say, well, Sean, how much do you need and what are you going to use it for? Well, voila, we just did that. We need $26,500, and it's going to help us cover these expenses. Now we're coming in with $50,000 that also help cover with these expenses. So maybe all their money is just going into the cash or helping us with some of these other ancillary expenses. But it's a really important step as you're developing projections, is to establish a firm starting point and how you got to these numbers. After that, we now start to look at the other expenses. We have our financing activities expense baked in here to our projections later on. We'll see that. But The other big expenses is payroll for a lot of businesses. And I like SCOR's financial projections template specifically because it breaks out payroll separately. And really what we need to do here, and I kind of skipped over this at the beginning, so I apologize, but if you see this dark shade of, what's this, orange, peach, I'm really bad with colors. And then you have this lighter shade. Well, this dark shade means we need to plug information in. This lighter shade just means we can adjust as needed. So when you're filling this out, really all we need to plug in is kind of the darker stuff. But when it comes to payroll, for my Taekwondo studio example, I'm going to say I've got 3 folks, myself, I'm an owner, and I'm working for $25 an hour, and I'm full-time at $40 hours a week. I'm going to have an instructor, $20 an hour, also full-time, and I'm going to have an assistant instructor. Now, as we go through this with the first pass, I usually kind of say, go through it with like a bit of a wish list item, like you're doing your Christmas list or, your wish list. We're going to come back and kind of chip away at that wish list if we're not able to make enough money or if we're not comfortable with what it's going to take to cover those costs. So right now, that's kind of my wish list. Now, you saw as I plugged in these very straightforward assumptions, one person, $25 an hour, 40 hours a week, it automatically calculated and did the math for pretty much my wages. So that's great. Now, when you employ people, you also have to take care of payroll taxes, and they have different rates. And so we're based on our wages, we're kind of calculating these payroll taxes as well. And one that I've highlighted here that I'm just plugging in at 2% is workers' compensation. Now that will vary from position to position, but it is important to budget for. That's $182 a month at 2%. But, depending on the type of position, like a forklift driver or something else, they do have varying rates, and they can get up there like 10, 12, 14% sometimes of wages. So I've highlighted that one as it may apply or not to your business. But we are looking at $9,100 in wages plus $953 in just payroll taxes for the employer side. So we've got a payroll to cover of about $10,000 a month. That's a lot, especially as we're just getting started. But I like the spreadsheet because it breaks it out separately from our operating expenses. Technically, payroll is like an operating expense, but it's a big one. And these are the assumptions that we're going to have to keep an eye on and really make sure we're making the best use of time, our scheduling, all that fun stuff. And you will see as you go through the various tabs down here at the bottom, we have 2A where we did our payroll, and then we have 2B where we can now say, we're going to budget, I don't know, let's say a 2% increase from year 1 to year 2 for our instructor. Another thing I might mention as payroll, you can, as a business owner, as I put here, you can pay yourself on payroll depending on how your company's set up, or you can take what's called an owner's distribution or an owner's draw straight from the bank account on the cash flow statement. So this spreadsheet can accommodate both. In this example, I'm going to say I'm going to pay myself on payroll, but this is a good question to ask your accountant. And usually they're going to say, well, how much are you going to make? And that's where enter your handy dandy projections template. So they can kind of figure out that not only from a tax perspective, but also any kind of payroll runs you might be doing. But I'm budgeting a 2% increase for my staff. Let's see here. Next is our sales. Now, this is a really tougher step or part of the projection for our startups, because it's really just grabbing stuff out of the air. Hopefully you come from the industry and you know what to expect, but it's really going to come out if you don't, or if you haven't come from the industry. We can come up with some assumptions. If you're an established business, this is where I'm asking you to run your income statement. So unlike the balance sheet at the starting point, here I'm asking for an income statement to kind of see what were sales and how were sales broken down if there is that level of detail. Were the sales all in the fourth quarter, or were they evenly distributed throughout the year? Kind of looking at the sales is sometimes more difficult. But in our projections template that we have here, we've got 2 boxes basically. Right here at the top, we've got our what I call our menu box or menu of products and services. So for our example, I'm going to say, well, we're a Taekwondo studio, and I'm going to plug in here that we have two major products or services that bring in revenue. This is how we organize it. We can organize it by monthly tuition. Our units are our students, and we charge on average $120 a month per student to learn the art of Taekwondo, or I should say the lifestyle of Taekwondo at our studio. Now, every month, we are also usually testing students. I remember when my son was studying Taekwondo, he would have a belt test to go from white to yellow and yellow to green, and you get all the stripes to get, to learn all the forms necessary to be able to test. But when it came time to test, we had to pay, as a parent or a customer, $50 just for him to take that test. So that's money coming into the business. And for the sake of example, to show you kind of how costs of goods work, every time so a student tests, well, as a business owner, we have to pay for a belt and a trophy. So let's say that costs us $3 because we buy in bulk on average. Now that we've got our sales or our what I call our menu box filled out, now you do have other categories here. And here I would say some words of advice are, keep it simple. Less is more. If you start having more than 6 major revenue sources, like we sell pies, we sell cakes, we sell crepes and all kinds. If you're a bakery, I would probably go with something a little bit more simplified, like orders. What's the average, dine-in order versus takeout order? If you're a car repair shop, like a mechanic, you're probably going to go with repair orders, and the average repair order has a certain number of labor associated with it and a certain number of parts and your cost on those parts. But this is where you can meet with your SBDC consultant to kind of think through, okay, what are we tracking? Because this is really where we're goal setting. Whether you're a startup or you're an established business owner, you want to be able to track or set goals for yourself on a month-over-month basis. And hopefully, if you're established, you're trying to do better this month, this year, like what are we in October, compared to this month last year. And so how many students did we have then? How many repair orders, et cetera? So less is more here. And think about what you're going to track, like what really moves the needle, what activities move the needle for your sales. But once we've got these kind of ironed out, in our case, we have 2. You'll notice as I plugged in monthly tuition, it automatically plugged in down here. And as I plugged in belt tests, it automatically plugged in down here. And as I said before, we just have to focus on plugging in the darker shade color here. And this is where we have our monthly sales forecast units. So how many students are we going to start with, let's say in January 2024? I'm going to just say, for sake of example, we've been doing this for a while at another studio. We've been talking to people about our dream to open our own. And we think we can start with 30 students, month 1. Big assumption, right? But then we're going to make another assumption and say we're going to grow by 5 students. Not by 3. I'm going to say equals 30 plus 5, not times 5. It'd be nice to get to 150 right away. But we're going to grow by 5 students a month for the first 12 months. Whether that comes to fruition or not, as an assumption that we're making. Maybe, and this is where as your SBDC advisor, I might say, well, how are you going to do that? And you might say, well, we've been in the industry and we know we have this great partner that can help us run an aggressive Google Ads campaign, or we know there's a big need and it's just waiting to be, tap that opportunity. Okay. But that's great for that revenue source. And you can see what happened here. 30 times 120 gives us 360. And if we had a cost of goods like we do in our next one, so let me go down to our next product or our service, belt tests. I'm going to say on average, we plan to do 20 students a month. We're going to test on average about 20, knowing though that it may be 30, it may be 15. But on average throughout the year, we do about 20 students a month testing. So 20 students times $50 a student gives us $1,000, and 20 students times $3, because we have to buy that trophy and belt, it gives us $60 as a cost of goods. So every time we sell a widget, a test, etc., we have this this cost that we have to contend with. So as the units go up, so does that cost, and so does the revenue. So this makes it easy to kind of budget for your variable costs if it relates directly to sales. So right away, we've now developed a sales forecast. Woohoo! And we've set some goals for ourselves. So the other thing I would mention for a lot of businesses in the budgeting process is sometimes you're going to go through this and then you're going to come back to it and be like, what was that based on again? How did we get to that number? So down here at the bottom, I'll usually kind of say, I'll write out what they are based on. And this is where the bank will also ask you for that too. What these numbers are great, Sean, but what are the assumptions that they're based on? Well, it's easy. We're starting out with 30 students in month 1 and growing by 5 students a month in the first 12 for the first 12 months. And we're assuming an average of 20 belt tests. Now I can throw in dollars here to make the math work out, but this is really what's important. And that's also why even at the starting point, I put these notes down here so I can remember, what are these numbers based on? So that's kind of I would say one of the hardest parts for our starting point. We're coming up with assumptions from our established businesses. You have a lot more to go off of. So looking at historicals, sometimes maybe adding a % increase, but really understanding what's going to drive that % increase. Are we opening up a new location? Are we adding a new service, etc.? So that's the sales side. And next, we will, before we get into expenses, is some of these other ancillary things that may or may not apply to your business. First and foremost is accounts receivable and accounts payable. Now, in these boxes, I've got budgeted pretty much 100% received within 30 days because that's like a cash-based business. Most businesses paid at the time of the sale, and vice versa. For accounts payable, you pay your rent upfront at the first of the month. So that's going to be most businesses. But if you offer terms where, I can pay you net 30 days, well, that's now becomes an accounts receivable. And we could look at an aging of your accounts receivable if you were an established business to say, how much money usually comes in within 30 days versus 60 versus over 60. And how much have you written off? Hopefully nothing as bad debt, but it does happen. So that's the AR and AP side of the house, because we can account for accounts receivable. Another funny one is a line of credit. So the first question is, what is the desired minimum cash balance that you want to have? And that's going to be different from business to business and person to person, quite honestly. And what it's asking here is, how low do you want to let the bank account get before you pull out the company credit card and start paying with plastic? So this is another reason why we want to kind of do the budgeting process to see, okay, what level of how much money do we need to keep on hand at any given time just to cover our costs? And so we haven't gotten to expenses yet, but we did do payroll, and payroll was about $10,000 a month. So here, for sake of example, I might throw in $10,000 we want to keep on hand at any time in our projection. So if we ever drop below $10,000 in cash, the spreadsheet will essentially assume that you have an indefinite line of credit, meaning like you have no top end. So, and we're going to say at 8%. Now, we all know that nobody has an indefinite line of credit. Well, maybe some people do, but I'm not one of them. So, and we want to keep our line of credit low. Not to say that a line of credit's a bad thing. We just want to know we have access to it if we need it. It's kind of like that plan B, hopefully. But I've got 8% here. You're going to have to talk to the bank that you bank with to see what they can offer you in terms of, can they even give you $10,000? And what would that interest rate be? Interest rates are changing all the time. So talk with your banker about what their options are, especially for your business. But anytime we go below $10,000 in cash, though, that excess of expenses that we're going to see on our cash flow statement will automatically be dropped onto a line of credit line item. And we're going to charge 8% on the balance for that. Another box here that I don't often use is additional fixed assets. But if we were, because I usually account for them in the starting point tab. But if we were going to buy a truck, middle of the year, that would be a fixed asset purchase, and we would start depreciating that then. But the big one here is Uncle Sam. That's that. I'm just throwing in 30% as kind of like a rule of thumb. But how much money are we going to set aside from our profits for Uncle Sam? Because he's got to get his cut, and we don't want to get hit with a tax bill that we weren't kind of expecting or ready for. So I'm going to throw in 30%. Again, talk with your accountant or whoever does your taxes about what you might set aside for you, because it's going to change from person to person dramatically. So rule of thumb, though, it might be 30%. And last but not least, and I know I've gone through this kind of quick, so we will open it up for questions, is now operating expenses. Now, this, if you notice, I'll just pull up a Schedule C PDF, because like a single member LLC or a sole proprietor is going to file their income tax return with a Schedule C. And I'm just pulling this up as an example so you can see here, advertising, car and truck, commissions and fees. Well, those are the same cost categories that we have here: advertising, car and truck, commissions and fees. And, you might go, hey, Sean, do you have one of those handy dandy common operating expenses thing like you had for, the starting point tab? And I could say, yes, I do. And because advertising, I mean, we all know what advertising is in general, but it gets really detailed. And so here we've got the breakdown. And I think I start with car and truck, but what is it? QuickBooks also has another link that I might drop in the chat that I came across recently for, what is included in advertising. Well, listing fees, web banners, promotional, there's a laundry list of things here. Car and truck. Well, this one's more specific because it depends on how is the car or the vehicle used part for work and part for personal, or is it all for work or for the business? But this is a good, I'll drop this one in the chat because I found this one to be pretty good in terms of just kind of understanding what these categories mean. But even if you're a S corporation and you file an 1120S or something different than the Schedule C, really what we want to do here is budget based on these, these categories, because we're going to have some expenses just to run the business, whether we sell one or we sell 1,000 students, signing up at our dojo. And so I'm just going to go over here and copy some numbers to kind of help us expedite this learning process. And I'm going to drop them in. I'm going to say, yeah, we're going to spend $150 a month in advertising for, let's say, I don't know, $30 a month for our MailChimp, and $120 in ads for our social media ads or something. But this is where you might want to do add a little note about that number so you can remember how you got to it. Contract labor, let's say we've got $100 a month that we're going to pay someone to help us with our bookkeeping, because we don't like that. So that's, if we don't do it ourselves, we're gonna have to hire it out, and that's going to cost us a bit. I've got some legal and professional, $500. I'm saying to, have someone file my taxes, but that could vary. Maybe I'll bump that up to $1,000 after I talk to somebody, because a lot of what we're doing here is we're coming up with assumptions, but then we got to go back those assumptions up by actually getting a quote or penciling out okay, yeah, it is $30 a month for MailChimp based on the plan that we want, or for our website, etc. Licenses, yeah, let's say $800 a year, because we're an LLC or something like that, a corporation. Earlier on the starting point tab, I had rent of $2,500 a month. That looks to be like our big ticket item, $30,000 a year just to have our space. And last but not least is utilities. I'm saying $150. That could probably get bumped up a bit, because utilities tends to include a lot: trash, water, electrical, pest control, internet, phone. There's a lot in that particular category. And again, that's where we go back to these common startup. That's not the common operating expenses. So it looks very similar, but these are now we're in business. Now we're running our business. And so commissions and fees, what percent of our sales are made on credit card versus cash or check? For that processing of the credit card, they're going to charge 2-3%. So we got to account for that. But the important thing is that we have them accounted for more so than honestly than the category that they're accounted in. But that we know what our operating expenses are, and we budget for them, because we got $2,900 a month just to kind of run this business. And now we just did a budget. So pat yourself on the back, because it isn't that hard, but it does take some time and research, whether you're an established business, to go back and look at your income statement and make sure you have all the line items categorized. Now, usually we'll do that on a separate Excel spreadsheet. You can download, if you're using QuickBooks or something, pretty much anything these days, you can download your income statement in an Excel format, and then put a little column next to it, like, oh yeah, this one's advertising, this one's car and truck, etc. But usually with my established businesses, what I'll do is I'll have another column to the right to say, is this cost going to increase, decrease, stay the same, or be eliminated entirely with the growth or the plan for the coming year? So for my startups, I'm really kind of playing devil's advocate here, like, oh, did you know you need a body art facility studio, if you're setting up a tattoo studio, or, we really dive into the details of kind of playing devil's advocate, like, did you account for everything? Because we were making assumptions that this is what it's going to cost to run the business. Whether we're right or we're wrong, we need to know how to pivot or adjust. So again, 5B, if we wanted to, we could add, a growth percentage. Let's say our rent goes up 5% every year. So, I plugged that in the wrong spot. Let's say 5%. So now we can adjust or account for that. So let's see here, operating. Something might be wrong with my formula here, but that's where you want to look at basically the different operating expenses that we might run into and how they might grow. Mainly what the bank's going to be looking at, and myself included, is the first 12 months. I mean, after 12 months, it's anybody's guess what's going to happen. But we take everything we just did, mainly our starting point, our sales, and our expenses, and we put them together into what they call a cash flow statement. And you'll often hear it, cash is king and cash flow is queen. And we're going to look at what we just did to see, are we making enough money? Let me zoom in here a little bit. Is that too much? No, that works. Okay. So what we're looking at here is January, or month one. We have a beginning balance of $20,000. Now that came from our starting point tab, where we said we were going to have working capital, cash on hand, or our initial cash deposit was going to be $20,000. That's why I said it's probably the most important number there. Theoretically, you could start with zero, but you need some money. It takes money to make money, right? So in our example, we're starting with $20,000. Now, a cash flow statement looks at the cash coming into the business and going out of the business. So first up is cash in. Our cash inflows are all sales, are all cash sales, really. We don't have any accounts receivable. So this $4,600 that's coming into the business, or is projected to come into the business, comes from our sales forecast, where we said we were going to sell 30 or have 30 students paying us $120 that month. And we were going to test about 20 students from the white to yellow and yellow to green, et cetera. So if we add up the 3,600 and the 1,000, we're at $4,600 coming in, and we got paid all in the same month. We didn't have any accounts receivable. So woohoo, $4,600 coming in. Now we look at the cash that goes out, and it goes out in a couple different ways. So if we start out here in cash outflows, you see, first and foremost, we have cost of goods. So for us to sell the $4,600 or bring that money in, it cost us $60 in those belts, those 20 students with, $3 per student. And we had operating expenses as well, the $2,900, which came from our 5A operating expenses, from these items right here for our marketing, our bookkeeper, our rent, and our utilities. You can see here that there's probably a lot more expenses that a studio would need to incur to kind of be running. But this is just to kind of get the ball rolling for you. A big ticket item we have here on our cash outflows is $10,000 for payroll. Well, that includes our payroll assumptions, which was all of these, me and two other people working at these respective rates for these many hours with the wages and the payroll taxes giving us 1053. So payroll is a big expense. So we're going to see if we can afford that here in a second. And the last but not least was we have that pesky loan payment. Oops, it's $563. Well, how did we get that? Well, back on our starting point tab, when we said we were starting this business, or even for an established business, this will be the loans you have on the books and the monthly payments you have. But we said we were going to finance $26,500 at 10% over 5 years, which gave us a $563 principal and interest monthly payment. Now, usually you can only expense, and that's why the biggest difference between a cash flow statement and an income statement is you're going to have cash expenses on a cash flow statement. So we have to pay the principal and interest in cash. Now we can only expense the interest part, and that's one of the subtle differences between the two, the income statement versus the cash flow statement. But we need the cash to cover that. So if we add up all our cash outflows, we get $13,576 going out. Doing some simple arithmetic here. We're starting with 20 in the bank. We bring in 4. We send out 13,500. So we technically 4,600 minus 13,500 gives us a negative cash flow for the month of 8,000, which we subtract from our beginning cash balance of 20 to leave us with 10. Now that becomes our ending cash balance for year 1, month 1, and the beginning cash balance for year 1, month 2. So it's a rinse and repeat kind of cycle from there. But what I'm seeing here is we're bringing in a little bit more money in month 2. We have similar operating expenses, so our loss really doesn't drop by all that much. And we are now, we've reached that threshold that we set earlier on the additional inputs tab, where we said we wanted to have $10,000 in cash at all times in the business. So we go below that, and now we start putting money on a line of credit. So now we start to see line of credit interest payments start to add up here. And I'm usually looking for a line of credit balance to tap out, and it looks like it continues to grow. So this is where we're out of money basically by month 2 or month 3. And this can be like oh man, Sean. But what I like to do with this wish list is kind of see now what would be our break even. What numbers in terms of students and belt tests do we need to hit each month to be able to afford our wish list? Because that's good to know too. So as we slide down, now you will get an income statement automatically prepared for you. You will get a balance sheet, all that fun stuff. But what I want to turn your attention to here is the break-even analysis tab. And now we're kind of looking at 2 things. Our margin on what we sell, it's pretty much 100% because we're largely a service-based business. But in our case, we're going to sell 94,800 and we're going to make 94,080 on that. So our margin on our sales, our gross margin is 99.2. So if we have basically this percent margin and we have all of these payroll and operating expenses, we have $168,000 to cover with this margin. So if we divide the 2, basically 99 divided by 168 means we need to sell $170,000 for the year. Now we divide that by 12, we get to 14,000, give or take, in sales if everything was divided evenly. Now I added this box down below to make it a little bit more unit driven. So if 83% or 87% of our sales is coming from monthly tuitions, that's the bulk of it, then basically 87% times that monthly sales volume we need to hit gives us 12,300 in monthly tuitions. If we divide that amount by $120 per student, we need to be about 103 students before we start to break even with our wish list. Now, and about looks like 36 belt tests on average a month. And this can go usually one of 3 ways when talking with clients. It can go, that's super easy. I could do that in my sleep, which is great. More power to you. It could go the opposite, and I could never do that if I tried and I didn't sleep. And I just worked at this business all day and night, which is good to know. Or it could go the third way, which is I could get there, Sean, but it's going to take me some time. And that is perfectly fine and reasonable. But just knowing, though, every month that you're not at 103 students paying you monthly tuition, you're losing money. So there's only 3 ways to grow a business. You increase sales, you cut expenses, or you improve your margin. Entrepreneurship to me is all about being creative about all 3. So now we can start pushing some numbers around and really start to have a little fun here. So we could go, well, we wanted to start out with an instructor, but it looks like, Sean, that's going to be you, my friend. So if I just get rid of this one cell and I say, 0, we just cut some expenses. Now let's go back and look at what our break even is. So now we drop from 103 to 74. Okay, let's see how we're doing cash wise. Because again, cash is king and cash flow is queen. And I often compare cash in the bank of a business to gas in the tank of a car. You wouldn't go for a long trip without getting into your car and first looking at the gas tank real quick, make sure you have enough gas to get there. Well, same thing. That's kind of what we're doing here. We're pushing some numbers around to, get in that car or that business, so to speak, to go, okay, do we have enough to get to that break even? That's our destination. Everything beyond that, now we're adding good, it's all for the good. But I see here on the line of credit that it taps out at about $17,013. So that is largely in part because that's when we hit that sales figure. If we go back to our sales forecast year 1, October is when we hit 75. Okay. So if we need that much line of credit, we can talk to our bank to see if we can qualify for it. Because, there's no sense in putting numbers down that we, can't really, put the money together. Or we can just know that we need to start with, instead of $20,000 in the bank, we need $37,000 to really make this a go. So that's kind of the aha moment of all of this budgeting that really takes a little bit of time to think through these numbers. I know I went through them fast, but now we can start tweaking with them and playing devil's advocate. Like, well, Sean, what if you changed not your margin, because your margin is it's 100% basically. But what if instead of charging 120, what if you charge 150? Now, how do we look? Just a simple change. Okay, now we hit our break even basically by, what is that, June? So, okay. But question is, will people pay $150? And you're kind of going, well, the competitors are charging about 110, 115. I think 120 is about all I can squeak out. Okay. But, so what does our break even look like now? Now we're down to 60. So again, that's why we saw that line of credit kind of tap out a little earlier. But this is budgeting, and it's not something you're going to do once and done, but you're going to do it kind of frequently throughout the course of your business and its growth, because you're going to have those questions to answer, like, well, how much am I going to pay myself, and what can I afford to spend on marketing, and all that fun stuff. So I went through it kind of quick, intentionally, because I want to make the best use of your time and attention. I know small business owners, we don't have a very long attention span, and that's okay. But I do want to open it up for questions if we have any. Sophia, have we got any questions?
We do not have any questions at this time.
I've just put everybody to sleep. No, this is the biggest question is, okay, Sean, I saw you do it. I'm going to take a crack at it myself. I've got the link to make, my own copy. And that's what we would encourage you to do, is kind of make a copy, tinker with the numbers. What I love about Google Sheets is even if you kind of mess it up, you can always get back to that version. There's somewhere up here or where you can go back to a certain date and time. So sometimes you learn the most by breaking things. But this is where now when you look at your financial statements, like your income statement, where these numbers are coming from, and it's not so much of a daunting task, because budgeting is like the vegetables of business. We all know we should eat them, but do we? Or do we reach for that bag of chips instead? No, this is a very important concept that we wanted to share with businesses in the community to help kind of better understand their business from a financial literacy kind of standpoint. So if any other question, I think something just came in. Was that a question or just more or less a statement, Sophia? Let's see here.
Not a question.
Not a question. All right. And I know it's going
you.
to take a little bit of time kind of getting behind the wheel yourself, using this tool or the Excel one and plugging in your numbers. But that's where the SBDC is here, and to help you be successful. And well, I always say the numbers don't lie. So if we could make it work number wise, we can probably make the rest work a little bit easier. But there is still a lot of effort that goes into where are we going to find that instructor or that assistant instructor. So if there's no other questions, my goal was to try to get it to an hour. I think I met that goal, and hopefully I'm able to give you 5 more minutes of your morning back to grab a cup of coffee and get on with the get on, as I always say. So I'll say thank you so much. If you're watching this on Zoom, you can just give us a call, schedule an appointment. We can go over this with you one-on-one, either in person or online. If you're watching this on social, you will need to visit our website to sign up for our free services, because everything is 100% free and confidential. But well, thank you very much for joining us today, and we hope to see you next time. Until then.